Good afternoon, everyone. We are the Group 5, and today we will be discussing the Chapter 10 and Ethical Decisions. And upon reading this chapter, you will be able to explain the role of accountants and other professionals as gatekeepers. Describe how conflicts of interest can arise for business professionals. Outline the requirements of the Sarbanes-Oxley Act. Describe the COSO framework. Define the control environment and the means by which ethics and culture can impact that environment. Discuss the legal obligations of a member of a board of directors. Chapter Objectives. Explain the ethical obligations of a member of a board of directors. Highlight the conflicts of interest in financial markets and discuss the ways in which they may be alleviated. Describe conflicts of interest in governance created by excessive executive compensation. And lastly, define insider trading and evaluate its potential for unethical behavior. It astounds me how little senior management gets a basic truth. If clients don't trust you, they will eventually stop doing business with you. It doesn't matter how smart you are. As Greg Smith said in the New York Times, "Why I am leaving Goldman Sachs." Trust is a very important aspect in a business matters, especially when negotiating with clients. They may be eager to do business with you in the start and for whatever reason, but if there's a mistrust, as Greg Smith said, they may eventually stop doing business with you. Introduction. The scandals of the early 2000s involved fundamental questions of corporate governance and responsibility. There were a rush of problems associated with the financial meltdown in 2007 to 2008. Ethics in the governance and financial arenas is now the most visible issue in the business ethics. Analysts contend that corruption is evidence of a complete failure in corporate governance structures. Corporate governance, the structure by which corporations are managed, directed, and controlled toward the objectives of fairness, accountability, and transparency. The structures generally will determine the relationship between the board of directors, the shareholders or owners of the firm, and the firm's executive or management.
The collapse of Enron Corporation had brought the ethics of finance to prominence at the start of the 21st century. Several important categories of business professionals, for example, lawyers, auditors, accountants, and financial analysts, function based on the internal controls that exist within market-based economic system. Role identities determines ethical duties and provide a source for rules, which determines how professionals ought to act. Gatekeepers. These gatekeepers act as watchdogs in the marketplace, ensuring that all participants adhere to the rules and regulations and conform to the market functions as they should. They play a vital role in maintaining transparency and integrity within the financial system. In the case of Enron, the collapse was a result of various unethical practices and the failure of gatekeepers to fulfill their duties effectively. The scandal exposed loopholes and shortcomings in the regulatory framework, leading to widespread public concern and distrust in the financial sector. The most basic ethical business issue facing gatekeepers involves a conflict of interest. This dilemma arises when individuals hold positions of trust that require them to make judgments on behalf of others, but their personal interests or obligation clash with the proper exercise of that judgment. Conflicts can arise when a person's ethical obligations in their professional duties clash with personal interests. Such professionals are said to have fiduciary duties, a legal duty grounded in trust to act on behalf or in the interest of others to their clients. Balancing personal interests with fiduciary duties requires a strong commitment to integrity and a clear understanding of the potential consequences of compromised judgment. By upholding their fiduciary duties and adhering to professional guidelines, gatekeepers can play a vital role in maintaining trust and ensuring ethical practices within the business world. So in this figure 10.1, where conflicts of interest in public CPA activity started with the client's board of directors, work directly with the client and have a possible conflict with the client's management team. Next, the client works with its own management team and hires a CPA firm and works daily with it. And then the client pays the CPA firm and has a vested interest in the CPA's report to the public. After that, the client has a financial obligation to the CPA firm, and then the CPA firm has a contractual obligation to the client. Then the CPA firm has a fiduciary and ethical obligation to the public to truthfully report the client's accounting information. And then lastly, the CPA firm has a contractual obligation with the client's management team. Because professional gatekeepers' duties are necessary conditions for the fair and effective functioning of economic markets, they should trump other responsibilities to one's employer. But knowing one's duties and fulfilling those duties are two separate issues. Gatekeepers may face challenges when attempting to uphold their professional responsibilities, and conflicting interests, pressures from employers, or other external factors can pose obstacles to fulfilling their gatekeeping duties effectively. They must have a strong ethical compass and a commitment to upholding professional standards. They must be aware of the potential conflicts that can arise and actively seek to mitigate them through transparency, independence, and adherence to established guidelines and codes of conduct. The gatekeeper function is necessary, but self-interest can make it difficult to fulfill gatekeeper duties. Society has a responsibility to create institutions and structures that will minimize these conflicts. And critics say government regulatory rules alone will not avert financial crisis. However, critics argue that relying solely on government regulatory rules is not enough to avert financial crisis. While regulation plays an important role in setting standards and ensuring compliance, they have limitations. Extraordinary executive compensation and conflicts of interest within the accounting and financial industries have created an environment where watchdogs have little ability to prevent harm. A string of corporate scandals shook investor confidence. In recent years, a string of corporate scandals has had a significant impact on investor confidence. Instances of fraud, accounting irregularities, and unethical practices have shaken trust in the business world. In response to these events, the U.S. Congress passed the Public Accounting Reform and Investor Protection of 2002, commonly known as the Sarbanes-Oxley Act. The act is enforced by the Securities and Exchange Commission, known as the CEC, and applies to more than 50,000 publicly held companies in the US and some foreign issuers. The European Union 8th Directive covers many of the same issues. The act introduced various provisions aimed at strengthening corporate accountability, enhancing transparency, and improving the quality of financial reporting, and it established stricter requirements for financial disclosures, internal controls, and corporate governance practices. Additionally,
the following section impacts corporate governance and board. First section, Section 201, were services outside the scope of auditors, no consulting rather than auditing. Section 301, Public Company Audit Committees, mandating majority of independence on any board and total absent of current or prior business relationships. Section 307 were rules of professional responsibilities for attorneys. Section 404 mandates that all publicly traded companies must establish internal controls and procedure for financial reporting and must document, test, and maintain those controls and procedures to ensure their effectiveness. Section 406, where the company must state whether it has adopted the code of ethics for the principal financial officer, principal accounting officer, and other senior financial officers. Section 407, where it requires that they actually have an expert and disclosure of audit committee financial expert. Internal controls are the mechanisms, rules, and procedures implemented by a company to ensure the integrity of financial and accounting information, promote accountability, and prevent fraud. One way to ensure controls is to utilize a framework advocated by the Committee of Sponsoring Organization or COSO. It helps to assure that the control activities performed by organization members are effective for the company to achieve its goals and eliminate unnecessary risks. Here we are discussing the elements comprising control structure. First, control environment is also the set of standards, processes, and structures that provide the basis for carrying out the internal control across the organization. Second, risk assessment, control activities, information and communication, ongoing monitoring. Just like what I've discussed earlier, COSO stands for Internal Controls, Move Audit, Compliance, and Governance from a numbers orientation to concern for the organizational environment. In 2004, COSO developed a new system where it served as a framework for management to evaluate and improve their firm's prevention, detection, and management of risks. Second, objective setting. It involves identifying or understanding what an organization or a division or a department is expected to achieve in the long term. And lastly, assist an organization in resolving ethical dilemmas based on a firm's missions, its culture, and tolerance for risk.
In this part of the report, we are going to discuss ethical decision making. Peter Drucker states that whenever an institution malfunctions as consistently as boards of directors have in nearly every major fiasco of the last 40 or 50 years, it is futile to blame men. It is the institution that malfunctions. In conclusion to this, boards of directors play a critical role in the success of a company, but they can also contribute to major fiascos. Institutions can help promote diversity, prevent groupthink, regulate overlapping boards, and ensure proper compensation. By addressing these functions, boards can become more effective and better able to guide their companies to success. Let us now go to our first topic, which is going beyond the law, ethical board members, and ethical governance. Ethical governance is crucial for long-term success and sustainability, while board members must prioritize ethical conduct, accountability, transparency, and sustainability. By doing so, they can build trust and credibility with stakeholders, mitigate risk, and protect the reputation of their organization. For legal duties of board members have a legal and ethical responsibility to ensure the company operates in compliance with laws and regulations, manage risk, and follows ethical business practices. Failure to do so can result in consequences for the company and its directors. Boards play a critical role in addressing ethical gray areas by setting standards, enforcing ethical behavior, and navigating competing interests. Boards can ensure that their organization operates ethically. It is important for boards to be aware of the challenges they may face and to be prepared to overcome them. In conclusion on these slides, the board's ethical responsibility goes beyond compliance. It's about doing what's right, not just what's legal. Ethical behavior is essential to build trust with stakeholders and contributes to long-term success. By embracing ethical values and best practices, organization can create a culture of ethical behavior and promote a positive workplace culture. For Angroti, it is essential that the activities of corporate executives are under constant, vigorous, and public scrutiny, because those activities are crucial to the economic well-being of society. In conclusion to this statement, transparency is an essential aspect of corporate leadership. It builds trust, enhances reputation, and mitigates risks. Non-disclosure can lead to suspicion, distrust, and legal and reputational risks. Companies that embrace transparency are more likely to succeed in the long run.
Next is conflict of interest in accounting and financial market. Conflict of interest in business normally refers to a situation in which an individual's personal interest conflict with the professional interest onto their employer or the company in which they are invested. Financial market encompasses any location or mechanism that allows buyers and sellers to trade financially instruments such as bonds, shares, various international currencies, and derivatives. Conflict of interest extends beyond the bedroom. Trust and structures that foster it are essential in the financial realm. Issues for anyone involved in the finance industry. Under this is stated that real or perceived conflicts can endure trust and often exist because of varying exchange of shareholders. Next is accounting. By definition, it is a set of standards that must be followed to present a company's financial situation and performs its operation and cash flows. First, it is intended that adhering to this principle will result in a fair and equitable treatment. Correct reporting of this information is an easily accessible format others interpret it. Second, whether in accountant it is considered a watchdog or greyhound depends on whether he is hired internationally or externally. After that, the American Institute of Certified Public Accountants, or AICPA, publishes professional rules to prevent accountants from being put into conflicts. First, GAAP, or Generally Accepted Accounting Principles, established by the Financial Accounting Standards Board, stipulates methods of gathering and reporting information. Lastly, accountants are also governed by the AICPA's Code of Professional Conduct. Next is executive compensation. Executive compensation, often known as executive pay, refers to pay packages established expressively for a company's business executives, senior management, and executive level personnel. Salary, perks, bonuses, and insurance are all part of executive remunerations. After area of corporate governance and finance have received as much as public security as executive compensation, in 1965, the average CEO pay was 20 times as much as the average worker's pay. By 2000, CEO pay has risen to 367 times as much as the average worker's pay. Even the decline the ratio remained high in 2016. Lastly, skyrocketing executive compensation package has raised numerous ethical questions. First, greed and avarice are the best phrases to describe the moral condition. From the standpoint of virtue ethics, the character of such personnel. Secondly, this reason fundamental issues of detective justice and fairness. Third is a serious ethical challenges arise against these practices even from a business perspective. Fourth, beyond issues of personal morality and economic fairness, excessive comprehension raises ethical issue of corporate governance and finance. In theory, compensation packages serves interest in two ways. First is they providing an incentive for executive performance. Second is they serve as a reward for accomplishments. Both rational have valid doubts in practice. In many circumstances, there is no relationship between pay and performance. Beyond a certain threshold, the rate of return of incentive decreases. Another critical aspect of governance is the disincentive that exists. Compensation packages and stock option realize given. First, executives have incentive to focus on short-term stock price rather than long-term corporate interest. Second, a case can be made that stock option may be able blame for the corruption involving management earnings. And lastly, excessive compensation can also involve a variety of conflicts of interest and criticism.
Duties of board members. Ensure executives are fairly and not excessively paid. Evaluate the executive's performance. Duties of senior executives. CEO often serves as the chair of board directors. Compensation received by board members is determined by the chief executive officers. Trading of securities by those who hold private inside information that would materially impact the value of the stock and that allows them to benefit from buying or selling the stock. Illegal insider trading occurs then corporate insiders provides tips to family members, friends, or others to buy or sell the company's stock based on that information. An insider is an officer, director, 10% stockholder, and anyone who possesses inside information because of his or her relationship with the company or with an officer, director, or principal stockholder of the company. Private information includes privileged information that has not been released yet to the public. The Securities and Exchange Commission has treated the detection and prosecution of insider trading violations as one of its enforcement priorities. Insider trading may also be based on a claim of unethical misappropriation of proprietary knowledge. The main argument against insider trading is that it is unfair and discourages ordinary people from participating in markets, making it more difficult for companies to raise capital. Insider trading based on material non-public information is illegal. Proprietary knowledge refers to the knowledge only those in the firm should have. Knowledge owned by the firm and not to be used by abusing one's fiduciary responsibilities to the firm. Considered unfair and unethical as it is, precludes fair pricing based on equal access of information. Is there sufficient deterrent to discourage insider trading in our markets today? There are multiple ways to reduce the risk of insider trading. One could be to conduct due diligence, investigate the background of potential and existing employees and suppliers, be wary of red flags, including non-financial misconduct, it's essential that you know whom you are dealing with and how they behave. Another could be to take extra care outside of the office, especially at trade or social events where you may be in close contact with other financial firms. Be sure to remove yourself immediately from any conversations that stray into sensitive topics or conversations that are off limits. And when you're on the move, take extra data protection precautions.